In this video, I'm going to share everything that you need to know about the brand new registered account that just launched in Canada called the First Home Savings Account, FHSA. So this account officially launched on April 1st, 2023, even though most financial institutions were not actually ready to launch the account by that date. I think the only institution that was ready, and they sent out a big, very excited press release, was Questrade. And from kind of some of the media outlets that I've been scouring, it looks like all of the big 6 banks are not ready, and they say we're going to be ready sometime in the spring or at some point this year. So I haven't found any other financial institution to say a firm date when they're ready. So at this moment of me making this video, there's only one place that you can open up this account. Nevertheless, eventually this account will be available pretty much everywhere. And if you want to become more informed and just be prepared for when it is ready for you to open, then this is what you need to know. Okay, so let's first talk about who is eligible to open up an FHSA. First and foremost, you can open up an FHSA if you are a resident of Canada and you are the age of majority. And that's not the only age restriction. There's also an age cap. So if you are over the age of 71, you are no longer eligible to open up an FHSA. Another really important requirement, and this is going to disqualify a lot of people, is if you or your spouse or common law partner owned a home and you lived in this home as your principal residence in either the calendar year or the prior 4 calendar years, then you are not eligible for an FHSA. For example, let's say you and your common law partner live in a condo that they bought before you started dating. Maybe you chip into the mortgage, but you were not on the title, you do not own the condo whatsoever. It doesn't actually matter because of these specific requirements. This disqualifies you from opening up an FHSA because your principal residence is owned by your common law partner. I know, it's annoying, it's not fair, that's just how it is. Next, let's talk about where you can open up an FHSA once more financial institutions actually have the account ready for you to open. So similar to a TFSA or an RRSP, you will be able to open up an FHSA at a bank, a credit union, a trust company, or a life insurance company. For example, that can look like opening up an account with BMO or Coast Capital or Canadian Western Trust Company or Manulife. Now, I grabbed that directly from the CRA's website, and what I found interesting was it forgot to mention investment dealers. So you can actually also open up an account with a robo-advisor or a discount brokerage. I mean, Questrade is the first company to offer this, and they're an investment dealer. They don't fall into those 4 other categories. So I think that's really important to take note of, which is great if you are a passive investor like me, and that's probably the route you'd want to go anyway. Okay, next let's talk about what you can actually put inside your FHSA. So I feel like there's going to be a lot of confusion, similar to when the TFSA was first launched in 2009 because of the title. So, TFSA stands for tax-free savings account. Even still, lots of people believe that you can only use it as a savings account, which means you can only put cash in your TFSA. Absolutely not. Actually, the best use of a TFSA is to invest inside it. And the same thing goes for the FHSA. Even though it's called the First Home Savings Account, it is not just a savings account. So don't just put cash in there earning very low interest. You can actually put any kind of security that you would put into a TFSA or an RRSP into your FHSA. So that could look like, of course, cash, but, GICs, bonds, mutual funds, and any kind of security that is listed on a designated stock exchange, such as stocks or exchange traded funds, ETFs. And honestly, if you're planning to save up for this home over the course of several years, such as 5+ years, it probably is a good idea to invest that money so it can grow into a bigger amount and keep pace with rising, housing prices instead of just leaving it in cash and again, earning very low interest. Then again, if you have a very short time horizon, just a couple years, then it may make more sense to keep it into something liquid like cash or GICs. Now, investing is a whole other video. I mean, I do have some videos on investing, but if you want to learn more specifically about how to invest as a Canadian and also specifically how to go about doing passive investing, which is investing in the entire market through index funds, then I do have a course called Wealth Building Blueprint for Canadians that you may want to check out. I will include a link in the description, but it is built specifically for Canadians. It goes really in depth about pretty much everything that you can think of when it comes to investing. So make sure to check that out. I also have a number of amazing books by Americans and Canadians about investing on my website. So make sure to check that out if you just want to start educating yourself more about investing. Now let's move on to account rules, because just like any registered account, there are lots of rules and it's really important to understand how they work so you do not make a costly mistake. Let's start with contributions. So this is really important to know, and I don't love it, but this is just how they've structured it. So you are allowed to contribute up to $8,000 per year for a total of $40,000. So that means if you were gonna do the max contribution every single year of $8,000, you would reach that total limit of $40,000 within 5 years. Now you may be thinking, wow, $40,000 is really not going to go far, especially how housing prices are going these days. You know, if you're kind of looking more long term, this is why it's a really good idea to invest it so that money can grow. And the other really great benefit is you are not taxed on any of that growth. So that's how it's kind of very similar to a TFSA. If it grows and it, you know, earns another $10,000 or $20,000 on your contributions, you do not have to pay tax on any of that growth. Another really cool thing is you can use the FHSA in conjunction with the RRSP Home Buyers Plan. Now, if you're not familiar with the RRSP First Time Home Buyers Plan, it basically is a program that you can utilize to borrow up to $35,000 from your RRSP to buy your first home. So that means if you maxed out your FHSA and then you participated in the First Time Home Buyers Plan, then you would have a total of $75,000. Let's say you're planning to buy a place with your partner and they're also eligible for both programs, then you can both combine both of your $75,000 to reach $150,000, a pretty substantial down payment for a place. And that's not to mention you, of course, can use, you know, money inside your TFSA or any of your unregistered accounts to kind of top up your down payment as well. Now, in terms of how to contribute to your FHSA, of course, you can just put new money into this account. But interestingly, you also have the option of transferring funds from your RRSP into your FHSA tax-free. Now, obviously, you still have to comply with the contribution rules of only $8,000 per year and the total of $40,000. But since the first-time home buyers plan inside your RRSP restricts you to only borrowing $35,000 from your RRSP, let's say you have a lot more money that you would like to unlock from that account, this is one way to kind of transfer money over to your FHSA and fund that account as well. Now, speaking of transfers, you are also allowed to transfer money that is inside your FHSA to another FHSA account that you hold. So just to make this really clear, and this is the same thing for your TFSA and your RRSP, you can have multiple accounts. The only restriction is your contribution room, right? But you can have an FHSA at, you know, Wealthsimple and then RBC and then Tangerine, for example. You can have 3 FHSAs. There's no limit on how many accounts you can have. The only limitation is, of course, that contribution room availability. But what's really important to note is if you're gonna do this, you gotta do it right. You do not want to mess this up because there could be a tax consequence. So what I mean by that, and this is honestly the same concept for your TFSA and your RRSP, is you need to make sure that you were doing the right paperwork, you were doing the transfer properly. Usually you would either, you know, talk to your advisor at the bank, or there would be a, you know, option if you're using, you know, discount brokerage or robo-advisor to do a transfer from or to another institution. I'm just saying this because a lot of people don't do this and they accidentally make a withdrawal from the account and then move that money and then contribute to that other account, and they don't realize that if you do that, you have to pay tax on that withdrawal. We really don't want to do that, so make sure, if you don't know how to do it, make sure to talk to a rep at whatever financial institution your account is to get the specific, you know, step-by-step on how to properly make this type of transfer. One other thing about transfers, you can also transfer funds that are inside your FHSA account to your RRSP or your RIF, your Registered Retirement Income Fund. Now, this is really something that you would probably only do if you've been funding your FHSA for years and then you decide, actually, I don't want to buy a house at all, I want to travel the world, or I just want to continue renting. Instead of pulling that money out of your FHSA and then having to pay tax on it, you can do a tax-free transfer to your RRSP or RIF. And the other really cool thing about doing this type of transfer is it does not affect your available RRSP contribution room. So effectively, by doing this transfer, you are gaining up to $40,000 in RRSP room for free. Okay, one more thing about contributions and then I'll move on. It is really important that you keep track of all of your contributions to your FHSA account. And again, this goes for your TFSA and your RRSP because most people don't do this. So you do not accidentally over contribute, because if you do, there's a tax you're going to have to pay. So for example, let's say that you open up an account in 2023 and you contribute $8,000 right off the bat, and you totally forget about this at the end of the year, and then you contribute another $1,000. So in total, you've contributed $9,000. Well, because you over contributed and you weren't supposed to, you're going to be taxed 1% per month on the highest excess amount in that account. Now, of course, there's a few things that you can do to rectify the situation. Once you notice this, you can withdraw that money and then you'll stop being taxed on that over contribution. Or you can simply wait until the next year when you get another $8,000 of contribution room, and then you'll stop being taxed because there's no longer an over contribution. You just kind of made a really early contribution for the following year. But even if you do wait until the following year, again, you're going to be taxed on the months that there was that over contribution. But honestly, this is so simple to to avoid. So please just keep track of your contributions in a simple spreadsheet. Next, let's talk about carry forwards. The good news is you can carry forward some of your FHSA contribution room to a future year, but there are some restrictions. Unlike a TFSA in which you get to accumulate your TFSA room every single year and you can carry forward any unused room into the future indefinitely, the same cannot be said for an FHSA. They only allow you to carry forward 1 year of unused room to a subsequent year. So that means, let's say you opened up an account in 2023, but then you didn't make your first contribution until 2025. Well, in 2025, you would have a total of $16,000 in available FHSA room. So that would look like $8,000 that you got from making your contribution in 2025, but then also $8,000 from, say, the year that you opened up the account in 2023. You would not be able to carry forward the unused room from 2024. So again, that's why it's so important to keep track of your contributions and keep track of these restrictions so you don't accidentally over contribute or just, muck it up. In my opinion, one of the biggest benefits of having an FHSA, and I'm a bit jealous because I'm not eligible to open up this account so I don't get access to this benefit, is your contributions to this account are tax deductible. So just like when you contribute to an RRSP, that contribution can be used for a tax deduction on your tax return, lowering your taxable income, saving you tax money, which is great. The same goes for your FHSA. Whatever you contribute can be used on your tax return as a tax deduction. And the other great thing is you do not have to use that tax deduction right away. You can use it for, the current tax year, or you can hold on to that tax deduction for a future year, such as when you're in a higher tax bracket and can really use those tax deductions. Another really important thing to take note of is you are not allowed to claim a tax deduction for a contribution to your FHSA once you've started making qualifying withdrawals from that account. Now, speaking of withdrawals, when you're ready to go buy your home and use the money that you've saved up in your FHSA, there is a specific process that you do have to follow. So first, you would make what's called a qualifying withdrawal from your account. And to make it a qualifying withdrawal, first thing you need to do is fill out a very special form. It is Form RC275, request to make a qualifying withdrawal from your FHSA. And not only do you have to fill out this form, you also then have to submit it to your FHSA issuer. Not only that, you need to make sure that you are also meeting any of those FHSA eligibility requirements that I mentioned earlier in this video, as well as have a written agreement to either buy or construct a home with the acquisition or construction completion date before October 1st of the year following the date of withdrawal. And of course, if this wasn't already obvious, the home that you're either going to buy or construct has to be in Canada, and it of course has to be your principal residence. It cannot be an investment property, it has to be the home that you live in. And lastly, I want to talk about closing your FHSA. So unlike a TFSA in which you can literally hold that account for as long as you live, that is not the case for an FHSA. It is really meant for one specific purpose, which is for you to eventually buy a home. You have to close your FHSA either on December 31st of the year that you turn 71, or the 15th anniversary of you opening up the account, or the year following your first qualifying withdrawal from the account. So that's pretty straightforward, right? You have to close your account after 15 years, and the year after you make your first withdrawal from the account, you gotta close it down. So those are really the most important things you need to know about an FHSA, but if you have any questions at all, please leave them in the comments. That's it for me. Thank you so much for watching, and I'll see you in my next video.